Thank you for joining the first episode of Restructuring Lawyers to Tax. As mentioned, this episode is going to focus on pass-through entities and individuals. This is part of a three-part series. Next month, we'll focus on corporate taxation or entities taxed as a corporation. And then the final episode in November will focus on cross-border and multi-jurisdictional tax issues. My name is Bob Richards. I head the Global Restructuring Group at the Dentons Law Firm, and I am your moderator for today. Speaking of the slides, you should understand from the get-go that we're not going to be reading the slides to you or reading all of the slides. They're more of a takeaway for after the program. This is intended to be a conversation between myself and the panelists today, but do keep your PowerPoint handy because I will show certain key slides to you during the course of the presentation. We have an excellent panel today. We have Eric Marksowski of NMBL Strategies. We have David Agler, who's currently with Agler Law and has also been associated with Crowe Horvath LLP. And then we have John Harrington, who heads the U.S. Tax Group here at Dentons. We appreciate that you're not spending your time and money to hear more about us. If you want more information about us, that's at slides 43 to 46. This webinar is a production of Financial Poise. To sign up for the great free weekly newsletter, just go to financialpoise.com/subscribe. As mentioned, if you have questions today and are attending the program live, just ask the question on the web portal and we'll try to get to you. If you're watching this afterwards on demand or have a question that you think about after today's webinar, just send an email to info@financialpoise.com, include your question and which webinar episode you're referencing, and we will get back to you with an answer. We also wanted to thank our sponsors for today, who are Mood Cannabis, Type to Learn, Mac Assets, and the Daily DAC. With that intro, let's start the discussion off today. I'm going to lead off on the one area I know the best, and then we'll hand it over to the tax experts. So let's talk about what kinds of insolvency an entity or individual may go through. So you can have insolvency outside of a formal process, just they can't pay their debts as they become due, they can't pay their loan when it matures, that kind of thing. You can have a formal bankruptcy, and there's various different chapters of bankruptcy today. We'll primarily focus on Chapter 11, which is the primary kind of business bankruptcy people pursue, but there are other kinds of bankruptcy, including Chapter 7 liquidation, which is available both for entities and for people. There's receivership. What a receivership is a court appoints an individual to either run a specific asset, often real estate, or it could be for an entire business, but it's essentially a court appointed officer, usually a state court officer, who will administer that asset. There are also assignments for the benefit of creditors, which is essentially a state law insolvency that's somewhat akin to Chapter 11 and varies by state. And finally, sometimes you have wider range debt workouts or debt compositions where you try to do a deal out of court with multiple creditors. With that, let's talk about the different kinds of taxes that we're going to be considering today. So, Eric, do you want to lead us off on that?
That'd be great. So thank you so much, Robert. I think it's kind of important to understand that there are federal, state, local, and foreign taxes potentially that come up. A lot of times I operate in the receivership and assignee space, and a couple things kind of quickly come up. But as a receiver, and if you're Chapter 11 trustee, you really need to be making sure initially you're giving notice to the IRS, to state and local governments, so that they're aware that you've taken over on behalf of a controlling entity. Typically, in that case, you're talking a state government entity, but you could also be taking over in a federal receivership and needing to give notice. The other thing that I like to look at when I step in and take control of these entities is, depending on the sector, you run into different problems, and also the size of the companies. So when you're looking at smaller companies, um, a lot of times they don't have a CFO that's necessarily truly a CFO as we might think of them in some of the larger entities that are out there. So sales and use taxes come about pretty quickly because oftentimes they've paid their local taxes, but maybe haven't understood that through sales that they've generated in other markets, they may be responsible for some of those other taxes across the state and across other states. Um, Obviously, income taxes, gross receipts taxes, payroll taxes with your federal and state governments. Um, you know, always erring on the side of caution and being overly communicative with those groups. And sometimes I know I hear from several other receivers in other groups that uh, they sometimes don't get a response real quickly from some of those government entities, but you're going to have to work on that because you don't want to put yourself into a liability by not getting something caught up when you're put in leading an organization and as a receiver. Or assignee is a little bit different, obviously, because you're assigning property to probably a new entity. Hopefully, if you're an assignee, you're not assigning it under your own personal name. But maybe some people have gone and done that, and that's probably not your best bet. So really looking through all these, you need to understand the industry you're in. You need to understand the entity you're taking over, and starting to look through what are some of those more common issues that arise based on where you're at and who you need to deal with for income taxes, franchise taxes, your gross receipt, payroll, sales and use tax. Uh, Happy, David, John, Robert, I'm happy if you guys have anything else that you want to share on this of what you've seen personally. But I think some of those, like I said, sales and use tax is one that I see pretty commonly that people don't understand to the depth that they maybe should when they're, especially in a small business. If they're probably under $50 million in revenue, they're probably not fully understanding of that entity and what tax liabilities might be out there.
I mean, the one thing I would add is, especially when they don't use a payroll service and cash is tight, I often see businesses skip paying payroll taxes because the taxing authorities generally are not as quick to catch on as a trade vendor pressing them for payments. So that's an area that I particularly focus on because those can be quite large if they're not remitting that to the federal and state authorities.
It's a great point. Yeah, the payroll softwares can be your best friend because a lot of times they're just automatically withdrawing those liabilities from you the minute you submit your payroll, and hopefully you're taking that issue off your own plate if you're running that company as a small business owner. I know I wouldn't want to have to be figuring out the proper sales or proper payroll taxes that I would be paying out, and it's beautiful to have companies out there like ADP or Gusto or any of the many entities that will do all that information gathering for you and just submit it all for you.
Great. Well, we talked about kinds of taxes. Let's talk about kinds of taxpayers. Eric, can you talk us through some of the kind of taxpayers and people that have to be concerned about taxes?
Yeah, I think there are a lot of, depending on how obviously the entities are structured, um, there are a lot of different taxpayers that can fall into, potentially at risk if a company hits an insolvency point or even before that. I know we're currently in managing a receivership that the company had never filed taxes. And they've been operating for about 5 years now. And so we're going back and going through and doing that. But we've got to protect this bottom bullet on here: fiduciaries, trustees, receivers, assignees. You do have to protect yourself, because if you go through that insolvency action and you don't catch everything, the IRS or the state government has some rights to come back after you personally. And so you really have to make sure that everything is getting taken care of so that you don't get hit with any personal uh, liability that goes with that. Obviously, taxpayers can include a variety of debtors. Um, I don't see that as much in the work that we do. I know some other entities may see some of those debtors. I guess I shouldn't say creditors. I guess I don't see as much hitting it, although they can. The debtors, obviously, there's personal liabilities that are involved with officers, directors, and shareholders that could come into play. There could also be clawbacks that revolve around how that gets played out, or even just how they've paid themselves over that time. Especially in small businesses, you see that officers, directors, and shareholders having a big hit because they've taken a lot of individual withdrawals from the company, and not necessarily paid taxes on it. So debtor and then their officers hitting it. Subsidiaries and affiliates also fall into it. We have a pretty unique scenario right now where a 40% ownership of a subsidiary that had also never filed taxes, and how we have control over, or lack of control over, what has happened with it, because we are still a minority owner. Yet we still have a liability and can't really file our own taxes without getting that cleared up. And so you run into a lot of unique scenarios, obviously, in the insolvency space. And so again, you're working through oftentimes courts, or sometimes not, outside of courts, to make sure that all those items get cleared up. I don't know if any of you have seen kind of some other unique scenarios around these different groups of taxpayers, and what what liabilities might lay out there that create problems for them.
Yeah, one thing I've seen with creditors is if you're, say, a bondholder and you end up getting 10 cents on the dollar in insolvency, and it may end up being to your benefit, but at some point you have a tax event that you have to, to report, and that you're not getting payment in full of your debt, and it may be a bad debt action or whatever, but that's one thing I see with creditors. Great. Well, David, why don't you begin the kind of the insolvency aspect of this by talking about some of the key impacts if an entity is insolvent here?
Well, let me start with the obvious, and that is that the insolvency, or the filing of bankruptcy, or the appointment of a receiver, or doing an assignment for the benefit of creditors does not exempt a debtor entity from the application of federal and state income tax laws. Although the bankruptcy code contains numerous tax-related provisions, it does not override the Internal Revenue Code for the purpose of filing tax returns and paying taxes, and also defers to the Internal Revenue Code for purposes, and state tax codes for purposes of determining tax liability. So as we go through this seminar and we talk about items of income, gain, loss, pass-through items, those are all determined under federal and state tax laws. For purposes of filing tax returns, the debtor entity is required to continue to file tax returns, federal and state. In the case of a receiver who is appointed for substantially all the assets of the debtor entity, the receiver is required to file tax returns, basically stepping into the shoes of the debtor. And I think Eric's going to discuss this later, but if the receivership is a qualified settlement fund, that entity may end up being a separate taxable entity, where the receiver has to file for the debtor and for the receivership. The insolvency or bankruptcy does not, as I mentioned, terminate the debtor, does not create a separate taxable estate like it does in bankruptcy. Only an individual Chapter 7 or an 11 bankruptcy creates a separate taxable estate. The insolvency bankruptcy does not change the debtor's pass-through entity classification, does not change if the member is like a single member LLC, part of an affiliated group that files consolidated income tax returns, doesn't affect the consolidated group, doesn't change accounting method, doesn't change taxpayers' accounting period. And also in the case of partnerships, does not prevent the IRS from applying the new audit rules that can impose an imputed, I won't call it a tax, but an imputed charge against the partnership rather than looking through flow through to the partners. And that's an important issue for creditors, for trustees that might want to avoid that by, if they can, electing out of these rules, or by doing what's called a push out, so that the entity in bankruptcy or insolvency is not required to pay the tax or the charge on behalf of its owners. At the owner level in a pass-through entity that's insolvent or bankrupt, it does not change the owner requiring to pick up and report as income and pay any applicable tax on the pass-through tax items from the insolvent entity. And it doesn't affect the owner's losses if it has loss carryovers or it has suspended losses. So all those items continue to occur as if there were no insolvency or bankruptcy.
And let's talk a little bit about how tax claims are specifically administered in a bankruptcy, and how they how a taxing authority would make its claims known in a bankruptcy a little bit, David.
Well, the bankruptcy code is designed to deal with all kinds of claims, secured claims, unsecured claims, government claims, including tax claims, and has actually a priority scheme for the payment of these claims. In the case of secured claims, and these are all defined under the bankruptcy code, 506 of the bankruptcy code provides for a bifurcation of secured claims where the collateral is less than the amount of claim, and under those provisions, the secured claim could be bifurcated into a part secured claim and a part unsecured claim. Section 507 of the bankruptcy code talks about priority in terms of unsecured claims, talks about administrative claims, employee claims up to a certain amount in terms of priority, and tax claims. Tax claims can fit into one of two areas, or at least one of two areas. In terms of tax claims where the tax is generated during the operation of the bankruptcy, that is an administrative claim, which has highest priority. And then other pre-bankruptcy claims normally fit into the eighth priority. In terms of other unsecured claims, 507 deals with various unsecured claims, as I mentioned, and has a priority scheme. Equity claims come last, and in most insolvency cases or bankruptcy cases where you're either dealing with a liquidation or a reorganization and there's no equity, you will see plans of reorganization basically cancel out equity claims if there's nothing to be paid and creditors are getting cents on the dollar.
Thank you. And one thing I want to note about tax claims is sometimes tax claims can also be secured claims. For instance, real estate taxes are generally secured. If a taxing authority has a claim for past due taxes and actually levies or files against the real estate, sometimes it can be both a priority tax claim and a secured claim, depending on the nature of the claim. John, we've been talking about pass-through entities. Can you explain a little more for the audience, kind of what entities are treated as pass-through entities for tax purposes? John, you're on mute.
Sorry, I was muted. Sorry, I wasn't. No, thank you, Bob. As a threshold matter, it's important to note that pass-through entity is an income tax concept, not a legal term. A pass-through entity is one in which the entity's income, deductions, and credits, the components of income tax liability, flow up to its owners. Those owners, not the entity itself, are subject to income tax on the pass-through entity's income. You can't tell whether an entity is a pass-through entity merely by looking at its name or form. The federal income tax classification of the entity depends on which income tax elections, if any, it or its owners have made. For example, a limited partnership, a general partnership, a limited liability company is by default a pass-through entity unless it's filed a Form 8832 electing to be treated as a corporation for federal income tax purposes. If it hasn't filed such a form, a limited partnership, a general partnership, or a limited liability company is treated as a partnership for federal income tax purposes if it has two or more owners. If it has only one owner, it's treated for federal income tax purposes as a disregarded entity of that single owner. Now, there are things called per se corporations. An entity that's formed as a corporation under state law is generally a corporation for federal income tax purposes. It can elect something else. But a corporation that's eligible to elect to be an S corporation is taxed similar to a partnership, and so it's treated as a pass-through entity as well. Now, as we know, there are less common entities, Q subs, grantor trusts, things like that, that can be treated as disregarded entities as well. The other thing to note about this is that any classification is generally just a federal income tax issue. States often follow the federal entity classification, but not always in their state income tax rules. And even if an entity is disregarded for federal income tax purposes, it can still be a separate entity for payroll taxes, sales taxes, and similar income taxes. So even who's liable for tax doesn't necessarily depend on whether it's a pass-through entity or not, but also whether or not what type of tax you're talking about.
Thanks. And let's talk a little bit about, I think you covered most of this slide, so let me move on to the next slide. So let's talk a little bit about the impact that entity level transactions can have on owners. Let's say that assets are sold for less than their basis, or they go through a bankruptcy and or an insolvency, and they don't pay their debts in full, they pay their debts 50 cents on the dollar. What kind of impact, if it's a pass-through entity, can that have on the owners of the entity?
Yeah, no, it's a good point. The fact that the owners and not the pass-through entity are subject to income tax on the entity's activities has several important implications. One is that it makes it harder to identify the income tax effects of transactions of an entity treated as a partnership for income tax purposes. The pass-through entity's owners often do not have the same tax status. For example, some may be individuals, some may be corporations, or the same tax attributes. For example, one may have a net operating loss and one may have a capital loss carried forward. So, for example, the example you gave where someone sells the entity sells an asset, perhaps at a loss, that could be if you've got it's flowing up to the partners. If one partner has a lot of capital gains, they may be happy with that capital loss. That helps offset those. If they don't have capital gains, that capital loss may not be usable to them. So that's not necessarily a benefit. It's just something tantalizing hanging out there. The other point I wanted to make is about this is that you have to pay attention to transactions that could result in a change in entity classification. For example, a change in ownership can result in a change in entity classification, and that can have tax implications. As an illustration, if a disregarded entity, an entity with a single owner, goes from one owner to two or more, for example, the existing owner is required to transfer shares to a second person, that entity is treated as a partnership. Those new owners are treated as forming a partnership for federal income tax purposes. Similarly, if a partnership goes from multiple owners to a single owner, one partner buys out the others or redeems out others, or they all sell to a new person, that partnership is treated as liquidating for federal income tax purposes. But the most significant thing often comes up is a change from corporate status to pass-through status. That sounds like a good thing, like if you want pass-through status, but there's effectively a tax charge from going from corporate to non-corporate status. It's a taxable liquidation, often at 2 levels for the entity and its owners. And then similarly with even if you convert from a partnership to a corporation, that may not itself be a taxable event, but it can it does mean that you've changed who's the taxpayer, who's subject to tax liability. These things we talked about, who bears the burden of things, who has to worry about tax consequences. It's shifted from the owners to the corporation if it goes from a pass-through entity to a corporation. And just one quick final point, outside of the corporate partnership distinction we've been talking about, there are other entities whose tax status is tied to certain ownership restrictions. And if there's a change in ownership, an entity that qualified as an S corporation or a REIT may no longer meet those requirements. So if there is some kind of transfer in ownership that's required as part of this workout regarding the potential insolvency or a distressed debtor, you can have a situation where that entity loses those the beneficial tax treatment it's getting. You got a taxable consequence of shifting from that to a corporation and going forward, and it affects the the valuing that may have taken place with attributes and tax liability.
Thanks, John. So David, let's talk a little bit about special issues to be considered both for partnerships and then for S corps.
Yeah, I'd like to build on what John just said, and but by now I think it's apparent that because of the nature of a pass-through entity, and when you're dealing with an insolvent or bankrupt entity and the equity is worthless, okay, or virtually worthless, that you have a situation where the owners of the pass-through are basically in a phantom income trap, that they're getting potential income without getting corresponding cash. And that presents a conflict for the equity owners and for the pass-through entity and its creditors. And John talked about making changes, from a pass-through to a non-pass-through, or a non-pass-through to a pass-through. But there's been a significant amount of litigation where, and this is especially in the S corporation area, where either before, during, a bankruptcy or an insolvency, the owners have tried to convert an S corp into a taxable C corp and trap income at the C corp level, which then could result in tax to the entity and less distributions to creditors. And so there's been litigation in that, and the courts have not been uniform as to how to treat that type of situation. Inside of bankruptcy, you have some courts that say an S corp status, okay, or even a pass-through partnership status is a property right that's protected in bankruptcy, and conversion from a pass-through to a taxable entity is not permitted, okay? Other courts have said, and this is the Majestic Casino case, that the pass-through entity status is not a property right, and therefore it's not protected, in that you can convert an S corp into a taxable C corp. In the case of partnerships, if you're dealing with an insolvent partnership, and John mentioned, normally conversion, of a partnership to a corporation is non-taxable, but if the liabilities of the partnership exceed its tax basis, then you have a potential for a taxable transaction on the conversion of the partnership to a C corp. And so, depending upon where you stand, as a creditor, the corporate, the entity, the pass-through entity, or you're an owner, you have all of these conflicting issues. And again, they, should be aware of what's going on depending upon where you stand. Other issues that you get into in terms of pass-throughs are, there are special loss limitation rules, and we talk about NOLs, but before you get to use an NOL, you should be aware for individual owners that there are rules that limit NOLs or pass-through of losses. These issues depend on tax basis that the owner has in the legal entity, whether the owner is, a passive owner or an active owner, and also, which come up frequently, is whether or not the owner is at risk. What it means is that to the extent that it's a pass-through of these losses and you don't have, either basis, or your basis is limited by at-risk or passive activity, that these losses become suspended. The third thing to keep in mind is there are always mismatching of income problems on flow-throughs from pass-through entities. And when I mean mismatching, I mean either you can have an owner that gets caught with ordinary income and a capital loss that don't offset. You can end up with an NOL that's subject to an 80% limitation. I think that's going to be discussed, or that John mentioned. You can have a situation where you have a timing issue where you end up with income in one year, a loss in a subsequent year, and you can't carry back the loss to offset income. And so that requires, planning to avoid mismatching problems.
Thanks. And Eric, can you talk about taxation of specific categories, particularly at the individual level, and some key considerations there?
Maybe I can, maybe I can't. If I can figure out how to use the mute button, yes, I can. So, it's one of those things where at the individual level, you're going through a lot of pieces here, and you're going through a lot of what John was talking about with pass-through entities. A lot of times when you're talking about a corporate insolvency action that's leading to, or a corporate restructuring that's leading to what brought about a receivership, an assignment, or a bankruptcy of any sort. And so really being conscious about how the pass-through entity affects the individual becomes critical, because if you're in as the receiver, if you're in as counsel for those, whether it's the plaintiff or the defendant, you're going to see rise to objections, obviously, if you're not paying attention and creating an action that sees a dramatic increase in the individual's tax situation. And it still may be the best decision possible for the action, but being really conscious and having really qualified advisors to give you that information becomes really critical, so that you can make sure that if you are making these decisions, that you're seeing, what the repercussions of those decisions are. We talk a lot about taxable gains and losses, and where they're realized. So obviously David and John really just touched on a number of items that are critically important as we look through all of these. Looking at the amount realized by the debtor, as I was saying, where you're not wanting them to, see a massive tax hit because of the implications that are being made, or if you are, you're actually doing it in a conscious decision. And we're looking at how the adjusted tax basis in the assets, as you dispose of them, have a federal income tax repercussion to all of it. So it's something David said earlier, and jumping back to it a little bit, of the receiver, especially you touched on filing taxes. I know there are a lot of receivers out there that write into their orders that they're not responsible for filing taxes. I think it's probably something that's not necessarily always the best decision. And at some point, the IRS may come back and say, we don't agree with that decision. But by making sure that you are playing a role in that tax situation, you start to look through these impacts on the individual income level. And I think that's something that every insolvency professional needs to have some understanding of, is the impacts of their decision-making process when they're going through individual or on the corporate side of things.
Yeah, and one thing I wanted to emphasize that's on this slide is, people understand when they have a closing and they sign a bill of sale or they sign a deed, that's a sale. But there can be many other things that, the owner doesn't do themselves that's still considered a sale, like a foreclosure sale. It's something that's more done by their lender or their trustee to them, but it doesn't mean that it doesn't have tax consequences for them.
I'd like to add something to what both of you just said. Bankruptcy code has a provision 505 that allows the court to make determinations of tax liability under certain circumstances. It's discretionary for pre-bankruptcy tax debt and also for taxes incurred during the bankruptcy. That provision overrides the Anti-Injunction Act, which prevents courts from making federal and state certain tax determinations. And what Eric mentioned about a court saying you don't have to, whether it be a federal or state court, that you don't have to, if you're a receiver, file tax returns. Okay, courts don't have that authority, at least in my opinion, and based on the Anti-Injunction Act. And my feeling is that what you want to make sure, since Eric will go into this, that receivers and other parties outside of, even in bankruptcy, okay, have potential personal liability for the failure to pay taxes, especially in the receiver context because of the federal priority statute, that you don't want your receiver not addressing these issues because, as I tell my receiver clients, it's not your assets, but it is your liability. So I just wanted to make that point.
Thanks. One of the major topics we're going to cover today that is cancellation of indebtedness income. And John is going to start us off on that discussion, but everyone's going to want to weigh in on that. So John, why don't you start discussing COD income and what it is, but then it is complex, it's multifaceted. So I welcome everyone weighing in on this important topic.
Sure. I mean, cancellation of indebtedness income is a real concern, particularly because the rules and consequences for cancellation of indebtedness income are not necessarily intuitive. In its most basic form, cancellation of indebtedness income occurs when a lender accepts a smaller payment from a borrower than the borrower initially agreed to make. Take a simple case. Lender makes a $100 loan to borrower with standard terms. Borrower determines that it can only pay $60 of principal back, and lender agrees to that lesser amount. In that case, the borrower has $40 of cancellation of indebtedness income to reflect the $40 in forgiven principal. Why? It's because borrower has $40 in income, just the same as if borrower earned $100 and only had $60 worth of expenses. Under the tax rules, you really only had to pay $60 to get $100, so you have $40 worth of income. Although this concept is straightforward, it's relatively complicated in practice, given the many instances in which it can arise. And we may talk about these, but a debtor may acquire its own debt. A lender may exchange old debt for new debt. The actions of a party, unilaterally or together, may cause the debt to change as a matter of operation of law. And to give an example, suppose a borrower and lender agree to modify a loan so that less payments are due. If the amendments constitute what under the tax rules are a significant modification to the loan, then the amendment is treated as though the borrower and lender exchange the old loan for a new one. This is an example that you get, Bob, of where there's a sale in a way that one would normally think of as a sale. That could be that's potentially a taxable exchange, and it can trigger cancellation of indebtedness income to the borrower. Now, how much of a problem cancellation of indebtedness income is for the borrower or its owners if borrowers are passed through entity depends on the circumstances. For example, there are exceptions for insolvency and bankruptcy and several other things that like you can see in the slides. And in those cases, instead of recognizing income, attributes like NOLs are reduced. If the amount of cancellation of indebtedness income is large and no exception applies, then the borrower may not have the cash to pay the income tax liability caused by the cancellation of indebtedness income. But also, as David and Eric talked earlier about attributes, sometimes the borrower has tax attributes, and if the borrower has tax attributes that will expire or otherwise be severely limited, cancellation of indebtedness income may not be a problem. It could be relatively costless to the borrower. So it really does depend on the particular circumstances as to how much of an issue a cancellation of indebtedness income is. But with there, I'll pause because I know both David and Eric may have comments.
Yeah. David, what do you have some observations on COD income and what you see in your experience?
Yeah, I think one important item, and Eric and John will probably get to this, is when we're talking about applying the bankruptcy and insolvency exception, and there are some other exceptions as well in this area, and there are also rules that basically say certain debt relief for tax purposes is not CODI that then goes through this attribute reduction. But it's important to understand, who gets, at what level do you apply the bankruptcy exception and the insolvency exception. And in the case of S corps, it's applied at the S corp level. In the case of tax partnerships and single member LLCs, it's applied at the owner level. And if the owner happens to be insolvent or in bankruptcy, then CODI is better than having gain from the sale of assets since it can be excluded.
And Eric, do you have some additional observations?
In my own experience, I think the two areas that we see this come up a lot are the debt for equity exchanges, because I don't think it's necessarily what people are thinking about when they're going through it. The other one we see this come into is personal guarantees. So you go through your insolvency action, you've paid out, as David referenced earlier, 10 cents on the dollar or whatever it is to the secured creditor, but there's a personal guarantee that kicks in and they reach a settlement with the bank or whoever was the secured lender, to pay back a portion of that. And the individual owner typically says, all right, I'm good now, I'm walking away. And I think that's where one of those scenarios where they haven't quite understood everything that goes into that insolvency action, and the settlement that they just reached.
Yeah, on the guarantee issue, there may be a CODI exclusion for certain guarantee relief.
Mm-hmm.
But one thing to keep in mind, and this goes to the complexity of how tax partnerships are taxed, and that is that unlike S corps, where everything gets allocated and distributed pro rata to ownership, tax partnerships can allocate income items, deductions differently, non-pro rata to tax partners. And also liabilities that give tax basis to partners can be allocated differently, especially in the case of a guarantee, where that would give that particular partner, tax partner, basis and probably allocations of losses if it's done correctly. If that guarantee goes away, if there is no CODI, that liability relief can shift basis away and cause deemed distributions, taxable distributions to the partner. And I just want to throw that out, that there are a lot of moving pieces here in guarantees.
And one area I see that these issues are very active in right now is commercial real estate and multifamily real estate, where the developer may have a bad project, would love to hand it back to its lender, but the developer may have other assets, other projects, and can't think of it just as one project, especially if it's a pass-through, because it may impact the rest of that developer's real estate empire and also the passive owners in it.
Yeah. Bob, you may want to skip a couple of slides. I had, it shows some of the exceptions we were talking about, the COD income exclusion exceptions. But that people can look at their leisure. And then the last thing, because I know we're kind of just be mindful of time, on the cancellation of dancing, we talked about that is a particular event, it is normally income inclusion to the borrower, which may be an entity or in past to any the entity's owners. But there are consequences, and both David and Eric were touching on those, that there are attribute reductions that can occur if there is an exclusion. And there's something you have to be mindful of. I think it's like, NOLs get reduced, other types of credits get reduced. There's no free lunch if you manage to avoid cancellation of Dennis income, it's effectively deferred. And that's just something, again, you have to be mindful of if you're modeling out the impact here about what some of these items are. Because one thing, and I think it's built on, one of the things I think that, particularly Dave was pointing out in terms of the partnership basis and the special allocation when it comes to partners. Sometimes you'll see the people that have NOLs, maybe even from the same investment, don't have the same interest in the entity as the cancellation of indebtedness income. So, and we'll talk a little bit, sometimes things don't match up. So you can have things where, the attributes don't necessarily reflect kind of who's getting the cancellation of indebtedness income. So if you're trying to figure out the financial impact of these or options, you really do have to carefully model these because of the potential use of attributes.
Thanks, John. And David, let's talk a little more about the debt modification rules and how those can impact from a tax perspective.
Yeah, this has been mentioned by you, Bob, John, and Eric. And that is that, there are rules mentioned that on the Cody side, if you exchange old debt for new debt, doing a physical exchange, there are also, if the issuer is a corporation, those transactions may also qualify if the underlying debt, that's the old debt and the new debt, is a quote security for tax purposes, may also result in the application of the tax-free reorganization or partially tax-free reorganization rules. It's called an e-reorganization. That's where you're doing the physical old for new. But if you do a material or significant modification of a debt obligation, okay, that can constitute a deemed debt for debt exchange, taxable exchange. And I think it was John who mentioned the E10, where it's treated as if, I guess the new debt is issued, the issuer is treated as issuing new debt with an issue price determined for under tax law for the old debt, and that can result in cancellation of debt income to the issuer, to the debtor. But it's also a taxable exchange for the creditor, and that could result in potential gain or loss, can result in the potential, debt write-off, can result in, depending upon the terms of the various debts, OID, original issue discount, issues for the creditor. And it could also result in, if the creditor has market discount, could end up causing acceleration of market discount, meaning phantom income. So these are important issues to look at. Now, what is a modification? And it's broadly defined as an alteration in a legal right or obligation of the issuer or the holder. What is a significant obligation? Okay, it is based on all facts and circumstances, the legal rights or obligations are altered or, quote, economically significant. Well, that gives you a lot of, comfort. All right. But the IRS regulations do mention several types of modifications, okay, and have special rules as to whether or not they're significant. So a change in interest rate, a change in debt instrument yield, a change in the timing or amount of a payment, the change in obligor or security, the change in the nature of a debt instrument, recourse to non-recourse, non-recourse to recourse, or changes in accounting or financial covenants can all be a significant modification. And it's really important that you look at these rules carefully, especially prior modifications, if any, to determine whether or not you have this issue and how to deal with it.
Thanks. John, talk to us a little bit about special considerations. You touched on it a little bit with NOLs and mismatches.
Yeah, yeah. No, we've talked about these somewhat, so maybe this will just be a quick summary. So we've talked about these income tax rules are technical and detailed, and so what looks like the answer on initial review may not be the answer once you've examined the facts or tax rules more closely. For example, I often hear things like the debtor shouldn't care whether there's income because it has large NOLs.
Yeah, I heard
And
that
yes, yeah.
a lot.
Yeah, and then we always, yeah, yeah, exactly.
Sorry.
Then you have to start trying to figure out how do I politely say this. NOLs may reduce or eliminate the pain of recognition of income, but you need to be sure, first of all, that the person recognized the income is the one with the NOL or the other relevant tax attributes. And two, you have to take into account the limitations on the use of NOLs. Like we note the 80% limitation on the use of NOLs, at least since the Tax Cut and Jobs Act, that provision came into force. There's change in ownership of of a corporation. You got Section 382 that can limit the impact. So just because those NOLs doesn't mean that they can be used. And then the second item I want to emphasize is the potential mismatch in income deductions, gains, and losses. I think as was pointed out earlier, capital losses can offset ordinary income only to a limited extent. So if a debtor expects a large amount of income, such as cancellation indebtedness income, that income can be offset by an ordinary loss. Say you've got an NOL or some other operating losses, but not a loss from the sale of a capital asset. So even if you have income and deductions, they may not be the right categories. But then even if they are in the right categories, they happen to be ordinary or capital, they both kind of match up in that sense. If they are considered to occur in different taxable years, the debtor may not be able to fully or timely utilize those attributes. So, sometimes it's only initially good news. It looks like there's offsetting income and deductions because you got to have them kind of match up to be able to be of full use.
Thanks, John. And we've talked a lot
Can I throw
about.
one thing in on this?
Please,
Okay.
please do.
And that is agreeing with everything John said. We have been talking about federal income tax issues primarily. And earlier we talked about the fact that other taxes apply. State and local taxes are really important in this issue of matching or mismatching. California has put a moratorium or suspended the use of NOLs except for certain low-income taxpayers, $1 million or less, but just that's a broad definition. Don't run with that. And also you have these issues where in a state context, you may have state NOLs that don't match with other state income. So keep in mind, there are a lot of moving pieces on that as well.
Great. And we spent a lot of time talking about owners and tax impacts on owners, but there are other people impacted here. Eric, can you maybe talk a little bit about how an insolvency might impact a lender or a supplier to an insolvent entity?
So, we see this happen a lot where, especially on the supplier side, a lot of times in depending on the action, the lender may have been engaged early on and kind of has counsel engaged to make sure that they're, receiving the proper information, proper feedback along the way. But you get suppliers and vendors that step in, maybe late to the game and don't have counsel engaged, or maybe don't have proper counsel engaged, that maybe aren't focused necessarily. They may be litigation focused, but don't understand necessarily the insolvency actions. And I think all of that has a repercussion to the supplier, and the lenders as well, if they don't have the right counsel engaged. And I think that's, from my own perspective, that's where we see people getting into issues, is they don't necessarily understand the process and the repercussions that come from all of this. And so, if nothing else, my key takeaway is always make sure you have qualified advisory and qualified counsel, because it'll make your life a lot easier as you go through all of this. On the kind of lender and supplier side, you run into, we've been talking a lot about this, of exchanging of debt. And so there are obviously within an insolvency action, especially if you're restructuring an entity, you may be agreeing to changing of that debt. The terms of it, you may be agreeing to extend it out and everything. And in turn, that obviously can have repercussions on the bank or the lender that's in place. And so I think, again, my simplest advice, that if no one takes anything else away from it, is make sure you have qualified counsel, qualified accountants, qualified attorneys, that are able to give you the advice of what the impacts of those actions are going to have on you.
Thanks, Eric. And one final constituents who we referenced as receivers and officers. Eric, do you want to talk a little bit about, what kind of concerns those kind of fiduciaries should have in tax situations?
Yeah, I think definitely in the receivership context, you have a fiduciary duty on behalf of the courts to step in, and that fiduciary duty extends not just to the plaintiffs and the defendants, but also to federal, state, and local taxing authorities. You want to make sure that, especially if you're in a general receivership where you're in possession of all or substantially all of the assets, you have given proper notice to the IRS, proper notice to the state, local tax authorities. One of the probably more common things that I see missed is people do make all of those declarations and then miss like a property tax that should have been paid, and start jeopardizing the property that's in place there. Again, I go back to the one key takeaway, qualified advisory is always going to be critical, not just on that notice side, but as you're going through all of these processes, to make sure that you are not creating tax issues for the receivership that are unintended consequences of your actions. And so it's great to have, firms that are out there that have experience. One of the things that I see, especially in single member LLCs, single entity individuals, you have a company that's probably grown slowly or quickly. They started out with maybe a solo practitioner attorney or solo practitioner accountant, and in turn, as that's grown, they've stuck with that individual who's been by their side that whole time, which there's something said for loyalty, but at a certain point you might need Crow or you might need Denton's to step in because they have an experience that goes beyond one brain. And so I think that's really kind of one of those things that if you're stepping in as the receiver, you have to understand who you've gotten in to take over their operations and what feedback they've been getting over the years, because that can also have tax issues that go on within the receivership, especially.
Great. Well, I want to thank the panel for a lively discussion. The episode next month focuses on corporate entities and entities taxed as a corporation, which can have some very different impacts from what we discussed today. So I would encourage you to attend the next episode as well, and want to thank everyone for listening in to today's episode. There are many other Financial Poise episodes, including related to bankruptcy and insolvency topics, available, and encourage you to to check those out as well. Thanks, everyone, and have a good day.